Well, welcome everyone back. I'm extraordinarily pleased to have with us Barry Sternlicht. And what I love about Barry is if you say you're going to have a meeting with Barry, everyone knows who you're going to go meet. It's like Oprah or Madonna or Elvis. You know who it's going to be. And so we have one of these living legends in the real estate business. For those that don't know, Barry is the chairman and CEO of Starwood Capital Group, which is the private alternative investment firm that he founded in 1991 that's focused on global real estate, hotel management, oil and gas, and energy infrastructure. Barry is also the chairman of Starwood Property Trust, the largest mortgage REIT in our business. He's also on the board of Invitation Homes, the largest single-family rental company. And for the past 27 years, Barry has structured investments with an asset value of over $100 billion. And maybe that's where we should start, because the investment world today is a little bit uncertain. So where are you, Barry, seeing the best opportunities, both in terms of geography or property type, to make investments?
Good morning, everyone. Was my mic on? Okay, good. And nice to see you and some old friends in the audience. Well, I think the biggest surprise of the year has to be rates. Right? I think when we started, as we raised our last fund, which was $7.5 billion roughly, I told investors my great fear, both for their current investing cycle and what we own today, was rates. Personally, I didn't really understand how we could come up with $1 trillion tax cut and a $300 billion stimulus package on top of an economy that was already moving when POTUS got into office. So you did it on a 4% unemployment rate. That $300 billion stimulus package, just to put it in context, not only did it have to be spent over 2 years, and that will expire at the end of this year, but the TARP package, if you remember, with the collapse of the financial system, the first package was $800 billion. We had a 10% unemployment rate. There's a massive injection of morphine into an already moving economy. So if the economy wasn't hopping now, we would be in serious trouble with all the efforts they've made to push this economy forward in the Republican administration. So it's a kind of steroid. I did think we'd see rates rise. What I didn't count on was the weakening of the world. And then, as people have said to me, and I've kind of adopted as my own theory, when you print $10 trillion, $12 trillion around the world in the global stimulus packages, it has to go somewhere, and it all seeks yield. And so it's been pushing the global rate complex lower. And the first sign of weakness, rates reversed, and the U.S. economy is running off its drugs, and we're weakening, we're slowing. So by backdrop, it's a question I know you're going to ask me. Rates were the biggest concern and probably the biggest home run of the year for real estate guys. Obviously, the REITs have rallied with the S&P, yeah. And nobody's particularly worried about rates. We started a home builder, Tri Point, and the home building stocks have reversed too, even though their business is sucky, because people expect it will get better as the curve resumes a more normal shape, and rates will probably go down the end of this year and into next year, because Trump will stomp on Jerome Powell's head if the economy weakens and he doesn't lower rates. So we have a strong tailwind now for the property sector. On top of that, a fairly balanced lending environment. The banks have not done any of the things you might have expected they do late in the cycle. But I do think we're significantly in the cycle. And I think the IPO boom you're going to see in front of us is usually like the bell. And it's when these guys want to get out, they don't want to hold these companies through the next recession or slowdown. I think it's a slowdown. I don't think we see a negative growth next year. But I do think you could see 1%, a one handle on GDP growth. It's nirvana for real estate. This is great for us. It doesn't induce tons of new supply. The markets are filling up across most asset classes. People won't go bonkers. And people will be nervous, so banks will put the brakes on construction loans as they already have. So to answer your question, which I didn't answer, we still like the multi-markets in selected locations. We own about 80,000 apartments today. Geographically, we prefer Europe to the US. Wider spreads between cap rates and debt rates. and generically much harder markets to add supply to. And if you look at the growth of office rents in Europe, they actually are better than most US cities, even though the European economies are kind of but a lot of their office stock is old, irrelevant, and they need space for the tech companies that that pushed our office markets forward. The FANG stocks, Amazon, Google, Netflix, you know where they are. As they move into cities like Berlin, where they're building, or London, they're changing entire areas, and that whole areas, they're willing to pay reasonable rents, high rents, and they want specific space. They're typically not moving into the 60s and 70s blocks, towers you've seen in many of these cities. So we recently bought assets in Milan, actually, two properties, one of which we leased to a co-working company, which you could guess which one it was, and we're going to flip it, and it'll make like a 70 IRR. We bought another building outside Milan.
70.
70.
7-0.
Yeah, 70 is good.
That's good
Yeah,
for
good.
students in the room.
For nothing to.
It's a very good IRR.
And we're selling it like 5 years early of our pro forma, but we didn't think we'd release the whole building before we even started the renovation. And then we did a deal outside Milan, like it was a 13 cash yield on a fully leased building to a Norwegian credit. So it's like we feel pretty comfortable, and Italy could leave the euro, so European Union, which will be a catastrophe. I can paint as dire a picture as you want, by the way, if you want me to. London, we kind of avoiding this until we see what the outcome is. There'll be really interesting buy opportunities. 10 years from now, London will be fine. Right? Whatever they do with their Brexit, London is unique among all global cities. And we're looking at entry points into the market, but right now it's pencils down. Unless we see a cap rate, we just bought a building on the south, fully let building in London, and we think a cap rate 100 basis points wide of almost a 6 cap, and a relatively new building. So the cash yields are great, and the tenants won't move for 10 years. So we're betting that at the outside of all this turmoil and nutsiness, you'll get a good cash yield, really great cash yield. We have a big bet in Germany. My favorite city in the world to invest is Berlin, because that's where the kids want to go in Germany. They don't want the banking complex of Frankfurt, and it's dirt cheap. Rents in Berlin are like a quarter of London, and probably less than half of Paris. And I'll bet on the Germans through the cycle. So we really like. It's very hard to get in there, and one of the problems is you have to be stomach like 3% and 4% yields. Right. But the 10 year's negative in Germany. So we're actually looking in a fairly large play right now in Japan. It's a market we've never lost money in, but we haven't been in more than a decade. And this is a public company situation. And we're deciding if we want to come out of our sneakers and be hostile. They wouldn't be hostile. We're not going to fire a single person. We just want to change their cap stack. So they don't look like a real estate company, but they are. So we've invested about half our fund in about 18 months, which shocks me, which is almost $4 billion of equity. We've bought a lot of office in the United States. We bought the Wells Fargo Tower in Minneapolis, the Wells Fargo Tower in Portland, the Wells Fargo Tower in Sacramento.
Is Wells the tenant?
I don't really know why they're all Wells Fargo towers, and I know they didn't sell them directly to us. But we're buying these deals. I tell people there are 3 green lights in real estate. I've been doing this 30 plus years. Positive spreads, right? We're buying at 5, 6, and 7s, financing 2, 3s, and 4. You're not financing at 2, 3, 4, 5. You're getting positive leverage. That is not what happened in 06 and 07, 08, right? You were buying in New York at 3 and financing at 6. So we still have positive leverage, so you get paid to wait if you get the call right. Second, generically, there's a lot of new construction in the United States, but generically the markets are fairly balanced. So the supply is under control. There are pockets of catastrophes coming, high-end residential in New York. There's some other issues in the hotel space, market specific. And so I think we've also done some hotel deals. We bought the St. Regis in Kauai for a lot of money. We're going to spend a ton of money renovating it and bringing it back as a one resort, the flagship for the brand, our new hotel brand. So it's a unique real estate. If you've been to Hanalei Bay, they'll never add another hotel there. So if we do a great job, we'll get the rates that the Four Seasons Maui is getting, which is almost $1,400 a night. I think we modeled $850 or $900. We'll pass that. We'll do better than that. And but we're spending a fortune on it. So those are the kinds of serious value-added things you do late in the cycle. Generic plays in hotels right now are not something we're interested in, because the hotel cycle is it'll obviously respond to the weakening economy. It follows GDP growth and demand. And there's a lot of hotels being built generically across the country.
So you talked about rates being the biggest risk as well as opportunity as you were thinking about things last year. How about the political environment? Whether that, I don't know, we only have 14 minutes left, so we don't have much time. But how do you think about it from a national perspective?
It is another reason we're going to have that slowdown next year, right? It's going to be just mesmerizing. Whoever it is the Democrats throw up as their candidate, if it's the left, I mean, it's going to be a free-for-all. And you're going to be completely glued to every TV set. Certainly every CEO in the country is going to wonder, are we become a socialist country and they're going to raise taxes, or are we going to be another 4 years of whatever this is, which is fairly random. You know, one day we're removing funding from the Special Olympics, and the next day he changed his mind. It's fairly, I know, many of you probably know Donald. I know Donald fairly well.
Another man with one name of.
The Donald.
Yeah.
So anyway, I look, the one thing you can say about the administration is business was no longer the villain, right? It made the sea change in the optimism of CEOs and business leaders of this country was real. The fight with China is a worthy fight. You know, leveling the playing field with China is something, having owned a company that had 50% import taxes of their goods into China, we don't do that to companies. So that's a real worthy fight that I'm glad he's fighting. Practically everything else I could throw out the door. You know, I think the corporate tax cut was overdone. I think it should have been done, but not to 21, maybe 25, or maybe leg into the trade. He didn't need the stimulus package at all. I think they should really examine the defense budget and cut it and readdress it to education reform. Teachers want bonuses. They should come out of the education. You don't need to tax the rich. They should just move around the $1 trillion they spend every year. So, you know, we should only, I agree NATO. NATO should pick up their costs, their share of fair costs. We shouldn't have to defend Germany. I mean, Germany should help in their defense. So some of it's rational, but a broken clock is right twice a day, and that's about the right, you know, strike zone for him. Right. So the jargon is just awful. What it's doing to the level of discourse is just awful. So, you know, and I worry that there's a graph I saw that shows that the swings are getting wider and wider between left and right, and that could do the unthinkable. You could have the far left has never had that big a voice, but it's only a voice because of the far right, right? I mean, the middle candidate is boring as shit and won't get any coverage. Like, nobody wants to talk about it anymore. Howard Schultz, I mean, my God, you think a guy was a child offender or something. Like, he's a real person with a real message, and he's a very successful, real billionaire. And
have you been to a Starbucks bathroom before?
I have been to a Starbucks bathroom. Why is that relevant? But anyway, I mean, it's funny because Mike Bloomberg said, you know, they saw that article, probably he'd run. I mean, everyone knows what a Starbucks is. Not many people outside this room know what a Bloomberg is. Right. So, you know, although one is really spectacularly wealthy, and the other one's just stupid, filthy rich. Right. So, but they're good. They're both great men, and you know, I'm not sure this nation's ready to elect someone like that. You know, we are New Yorkers. We are the elite because you live here. I grew up in this area, and you really have to get in touch with the rest of the country because this man is a hero, a complete hero, and nothing you can say will change their opinion. Nothing. So, you know, I don't know. I don't know. I'm a centrist. So
you have a prediction on 2022?
You don't know who the Democratic candidate is. You can't have a prediction. I actually thought Donald would be in far worse trouble from the Mueller report, so I have to revise my thinking. And if the economy does slow and the stock market starts to give up a lot of stuff, Donald could get fairly hysterical. And if they go middle, they'll win, the Democrats. If they go left, they'll lose.
Right. You talked about value add in hotels.
I won't vote for Bernie Sanders or Elizabeth Warren.
You will not.
No, I don't. I'll vote for my mom. I'll do a write-in. I don't know what I'll do. I guess I don't know what I'll do. We'll see.
So you talked about the value add deal in Hawaii. You probably have more experience than most in the hotel business. I can remember when you had all the beds lined up and you literally slept in all of them to create the heavenly bed for Westin over 20 years ago. So what are you doing now to innovate in the hotel space?
Well, some of you may know we started a new brand called One Hotels, and it's a mission-driven brand. It's about teaching people they can live well and still live luxuriously. So we just recently sold the hotel in Miami, which was I didn't really want to sell it, but it was the end of our fund life. For the highest price ever paid for a hotel outside of New York in the United States, 1.4 something million a key. But it was crushing it. So we have almost 20 of these hotels under development around the world. Sanya, China, Cabo. We signed a deal in Melbourne, London, Paris, Nashville, Toronto, San Francisco, Hawaii. We have the Brooklyn Hotel, the one here in Manhattan, and the one in Miami, and then I'm missing a few. So it's growing faster than W Hotels, which is kind of fun for me because this one we're doing in our own account. And then we have a sister brand, which is cheaper, that we haven't really announced, so I won't do it here, but the first one will be in London.
No, there's no press in the audience.
And then Seattle. There's competitors. So we'll do those. They'll be fun. And then we do the Baccarat Hotel, which we sold. Right. And we're doing a few of those in Macau. It's not really a pressing need for me to do those. The economics are frankly better behind the one brand.
Yeah.
And I think it is interesting. What we're trying to do in hotels now is find things we can transform. We can take an old DoubleTree and make it into something better. The generic, you probably don't know this, we also own like 400 limited service hotels. I mean, that's going to be, they have great cash yields, but it's going to be a while before you see 5% RevPAR growth or even 4% in that asset category for a while. Nationally, I think they're doing 1 or 2%, which is small NOI increases above that if you can hold property taxes in line, which generically you're having trouble doing.
Right.
I mean, it is interesting what's going on in the world. I mean, it's this move of the millennial generation to find brands that mean something is permeating everything in real estate. And so whether you're a retailer or you're a mall or a co-working space or co-living, I mean, this is a different world and it's much easier to build brands today than it was when I started. Right. We run these one hotels with 20 people at corporate in the 90s in the occupancy without charging owners, $7 billion a year for global sales forces and fancy tech systems, reservation systems. A lot of this is about the product. The product's good, the store is good, if the mall's good, if your landscape is good, if your light is good, if your sound system's good, the customers come and they show up. Everything else is like, yeah, I've seen I love WeWorks, it's a great company, but they have this, they'll show you if you go and demonstrate their stuff, they have a desk that sort of recognizes you when you put a card into the desk, and the desk will rise to the height if you're standing that you are. It's fantastic. There's not a reason you're going to take the building, right? It's like it's just sprinkles on ice cream. If the ice cream isn't good, the sprinkles aren't going to make it better. So you got to get the product right. And everything I think real estate guys forget. It's all about the product. I continue to be marvel when I travel the world. Like you wonder who the architect was and who the developer was that built a hotel on the beach with no windows. It happens all the time. You're like, what? In the one South Beach, you can see it because there's the tower. We own one of the two towers that face the water. One is solid sheetrock or cinder block, and the other one we took the whole facade down and put up glass. You're like, really? What were you thinking? We're going to go to the beach and we're not going to look at the ocean. So stuff like that happens. That's the opportunity, and you just got to look. I mean, I'm surprised, frankly, that in this late in the cycle, we found so many things to do. The one other thing I'd say about the cycle is the one big bubble, and this is really important that across asset classes people realize, the tech world has invaded the stock market. It's 25% of the S&P. It's only 5% of the Euro stocks. And when you look at things like office absorption in this country, I think 40% is like 10 companies. they are the office market. They are the guys that are, it's not the banks, it's not the service companies, it's these tech companies, whether it's Amazon, Google, Facebook, and they are driving office demand. If they hiccup in the public markets, not only does the S&P go down, but the real estate markets will go down. And so we're all correlated to each other. We are probably more correlated because there's more concentrated demand than it's ever been the case in the U.S. property sector. These are really, really critical companies for the health of the real estate market right now.
And you mentioned expecting a slowdown, not a recession. So I guess is that...
I don't see excesses. I don't, other than tech. You know, I was shown on the plane here, I just arrived this morning, we were looking at a company that somebody's raising money for, and you know, it loses money for the next 5 years, and I think they wanted to start it out with a $200 million valuation. In the old days, we'd raise money from you, we'd give you your money back, we'd pay you a pref, and then we'd split the profits.
Right.
Here you come with an idea, they put in a tech wrapper, they put a $200 million value on it, and you get to buy 5% of it, you know, for $10 million, or $200 million for the idea, and 2 guys. And they really have, in an undisciplined way, even in real estate, right. You see these co-living companies, Common, or the deals like Industrious. These are real companies. The valuations are bananas.
Right.
Bananas. But short term, they may be validated. Like, I'm not suggesting Uber's a similar company, but if you can sell it and you can get out of it, then you were right. But as a fundamental, as the Graham Dodd, whatever his name was, investor, you know, Benjamin Graham? Who's the other guy? Dodd? Was it Dodd?
Dodd. Well,
Dodd.
I don't think about
Who wrote
Dodd-Frank.
the book on? No, not Dodd. It was the guy who wrote the book on value investing. You know, it's not the kind of things I do.
Right.
I like cash flow. I worked for Neil Bloom. He's crazy with cash flow, right? So I like things I can understand at multiples I can understand. So I have to see a way to profitability in these companies. So the tech rec obviously would have a hell of a situation in San Francisco. And I always, having lived through 2000 and 2001, I remind young people that the next step down from a $40 billion valuation is not 38, it's 3, right? There's no floor on this elevator. Once these companies are losing money, lose a funding source, then you're like, well, you know, with $3 billion, I'm interested, down from 40. So that's what happened. You can actually, it's what happened. And when I was running Starwood Hotels, we were making $1.6 billion. I was at a JP Morgan conference in Aspen. I'm sitting next to this woman who has a company I've never heard of. She has $4 million in revenue and a market cap 5 times mine. I sat at lunch, I said, you should buy me. I have real cash flow. I tried to sell myself to some fake telecommunications company. And, you know, and then she wasn't around a year later. They were gone. And this is 20 years now, so you're talking a generation. People don't know this. The 30-year-olds did not live through 01 and 0, when you had to be part of the tech bubble, because everyone around you was getting rich with 5, you know, it was crazy. It's not that far off from that. There are more companies valued at 10 times revenue in the public market today than there were in 2001. I'll show you the chart. I should have brought it, but it shocked me.
Right.
And then there's an amazing quote from Larry Ellison about how stupid it is to buy companies at 10 times revenue. With all due respect to Wall Street analysts, they say, oh, it's only 5 times revenue, and this one's 6 times revenue.
The thing is, I cover real estate companies. I don't trade that way.
Companies aren't built the same way. They have different margins, different customer bases, different geographies, different products. But you know, this multiple of revenue is one of the dumbest things I've ever seen and created in my life. Right. I mean, it's ridiculous.
How do you think, you've talked a little bit about co-working and co-living in some of your comments. You talked about some maybe bananas.
So the issue with co-working...
But how do you think about the wider adoption of those by the user base and its impact? Put aside the whole valuation piece of it.
So WeWorks, or the shared office, is a real business. This is a very smart business. This is the disintermediation of the lease stream, just like Lou Ranieri disintermediated the mortgages, you know, single-family mortgages. Yeah. You can get, instead of getting a 10-year deal or a 5-year deal, you can get a 1-month deal or a 3-month deal. If you get really big, any one guy leaving isn't going to crush you. So this is a real company. It's a question of the valuation. And again, I don't know. You had basically one guy mark that company, SoftBank. They put $10 billion in. I mean, it's going to be it's the biggest bet in venture capital history. Could be Amazon. It could happen. So anyway, it's a real business, and I probably didn't appreciate how powerful this is, particularly in cities like London, where they have 25-year leases, and no small startup wants to sign a 25-year lease. So in those 2 cities, WeWorks makes a fortune, right? When you go to co-living, as you know, if you have kids and they've looked at some of these products, it's not cheaper than you getting your own apartment, sharing it with other guys. We already had co-living. It was my son living with 3 guys in a 2-bedroom flat, right? That was
Put up the wall. Yeah,
That's the
I did that.
traditional co-living
Yes.
model, and it didn't get valued at $100 million for his idea to do that. So, you know, I think it's been harder. WeWorks has, WeLive has, I think, 2 products. We've looked hard at the space. Everything's merging, right? They want to do co-living. Are they doing daily rentals? That's a hotel. Are they doing extended stay hotels? Are they doing a year lease?
Right.
Everything is converging on each other. And then you'll throw in a little co-working space into your hotel or into your co-working. So everything is coming together. It feels a little crowded. And it's very hard, you know, time-wise, it's much easier to renovate a floor in an office building than do an entire building to do a co-working space. And you have to retrofit everything if it's an existing building. So it has to be a new build. And it's expensive. Yeah. And it only really works in cities like New York and San Francisco where rents for 1-bedroom apartments are just stratospheric. Right. And I think it's like, it's a niche. It's a niche between when a kid gets out of school and he's 22 and doesn't have a ton of money, hasn't gotten his first job, and when he's 32 or 34 and gets married. Right. You know, or somewhere, it's like, you know, when you're in college, every one of us was in college most likely. I mean, we got our shared room our freshman year and we couldn't wait to get our single. Right? The same thing happens when you're 22. I get out of school, I'd love to have a single, I can't afford it. I have a co-working room. And then when I grow up, I'll have my own house or my own apartment. So I think it's a niche play. I don't think it's it's big, but it only works in certain cities. It's not gonna work in low, you can't afford it or don't need it in cities like Houston. Right.
We have time for a question. Does anybody have a question for Barry? Just raise your hand or stand up. You don't have to be shy. I'm going to give you, if no one raises their hand, I'm going to give you 2 rapid fire. We have more or less public REITs a year from now?
Less.
10-year Treasury, today is about 2.5. Where is it a year from now?
It was 244.
Well, I rounded. I rounded the wrong way, clearly.
I only watch,
Not that he's paying any attention.
Every morning I look at the yield curve. Well, that's another thing. The yield curve is rarely wrong.
Yeah, it is.
Version of the yield curve will, it's not going to be wrong this time either. Probably 2.25.
And do you think the U.S. will enter a recession? And if so, what year?
You know, recession, no. Significant slowdown will feel like a recession, yes, next year. And my guess is the stock market starts paying attention to this sometime late this year. Right. But I'd say one more thing, which you didn't ask me, flow of funds. Yeah. Nothing, you know, we talk about fundamentals, but you get overrun by flow of funds. So the property sector today, I mean, we don't have the Japanese buying the REITs the way we were. The Chinese are out of the property market almost completely. Yep. So the 2 foreign areas that have recently bought portfolios from us are Southeast Asia. Korea's even slowing down a little bit. And there is some interest still from the Middle East because they're underweighted. But this is going to have to be a domestic-driven market probably. You know, I think our funds, most of our capital now, more than half is offshore. But the level of interest is high. The feeling, the need to actually do something is low. Right. People are expecting this recession. And you know, but you can see the winners are winning big. And one of the reasons I think there'll be fewer public companies, there's large amounts of uncommitted capital in the private world, and we will take down the REITs. We will make offers for them. We actually have dozens of REITs we take private ourselves. We just don't think you'll sell to us. Right. So at a price that we would be willing to buy you at. We take your stock out now, but you wouldn't sell it here. So we've recently, there was a company in Austin that received an offer, and there was a company we wanted to buy. But the pricing here is not doable for us. Right. For private capital. So we can lever more highly than the publics can, so that's simply an arbitrage. And we might have a more aggressive view on growth than the analyst community has in certain markets on rents. Yeah. So that's really where the play comes in.
Right. Well, I greatly appreciate your time. Thank you so much.